Thank you all for coming out. Is there anybody that's here for the first time? A few of you? Perfect. Thanks for coming out. For those of you that don't know, my name is Chris Good. I am a real estate broker, real estate investor, the host of the group. And I got my start, or I guess the inspiration to start, I should say, through meetings and groups like this. So I'll be forever grateful for the hosts that put those meetings together, and it's an honor to be able to return the favor a little bit. Meetings like this do come with some expenses, and we have sponsors that help cover those expenses. I'll give a shout out to them, and then we'll have somebody give us a little market update for Lancaster County real estate market. Then we'll pull up our panel. So our sponsors for 2026 are Providence Real Estate Settlement Services. Chet Lapp is the owner there. Astoria Realty, that's a real estate brokerage owned by myself and Benuel Esh, one of the panelists here tonight. Jeff Mohler, also one of the panelists. He's a private money lender. Joe Liofsky, he's not here this evening, but he spoke here last month and has been here from the start. Also, Redbox Dumpsters of Lancaster. Sam Glick is the owner of that. And those are the folks that help keep the lights on. So Ethan, when you're ready, feel free to come up and I'll let you give your update. Ethan's one of our agents, by the way, at the brokerage, and he's been doing a really good job. We enjoy having him. Yeah, right here on the... Testing. There we go.
Power button.
Give it like 3 seconds. That should go.
Sure.
All good?
Sweet. Thank you, Chris. It's good to be here with all of you tonight. Some of you guys may recognize me. I've done the market update a handful of times on Ben and Chris's team and get to do some real estate with them. So they're great people to be mentored by. So jumping into the market update, it's a little bit different than a typical update. I'm not actually going to go into details about the real estate market per se, because I shared that the last couple of times, and I feel like it'd be relevant to talk about the reassessments that just came out. I'm sure a lot of you guys, if not all of you guys, have received some reassessments. And Jake had a Facebook post the other day that I had come across, and I was like, oh my word, that'd be a perfect topic to talk about. Thank you, Jake, for your guidance on this, but hopefully I can explain this enough. I know it's a confusing topic. I'm not 100% clear on it myself, but I did a little bit of research, and hopefully this can give some break apart some of the terms that are involved in a reassessment and kind of what it means. So what is the purpose of the reassessments? So these are updated values of your property, and they are trying to update and realign with the current market values of the properties. So they would just be updating these so they can more closely reflect what the actual market value of the property is. Obviously that changes over time and over the course of the reassessments, which in a later slide you'll see it's roughly about 8 years is when they do the reassessments. So the goal of it is to create more of a fair distribution of these taxes. So it's just to share them across property owners in the county based on the values, the updated assessed values of the property. So the millage rate is what's adjusted, and these are applied to the new assessment values, giving you what your property tax would be. So these are just breaking down some explanations of what these are. So a tax levy, it's just the total amount of property tax revenue that a local municipality or government collects to fund its budget. That's your school taxes, your county taxes, and then the millage rate is the rate that they use to calculate your taxes from the assessed values of the properties. And that's just a little bit of a formula and a breakdown of how they do that. So like I said previously, this happens every 8 years. Last one was in 2018. Obviously, 2027 is not 8 years from 2018, but it was scheduled for 2025, and because of the volatility of the market and the uncertainty of what was happening in the market at that point from the COVID time in the real estate market, they gave it a 2-year buffer, pushed it back, and that's why we're hitting the reassessment in 2027 here. So, big question everybody wants to know, will my taxes go up? And it's possible, but it's also not certain. So everybody's property is assessed, like I said, based on the market value. Even if your property value and a property assessment increases, the taxing authorities must adjust the tax rates to keep it revenue neutral. It's basically just trying to balance a budget. They're just trying to balance out the taxes among property owners so that people who bought a house in 2018, it's a lot more valuable in 2027 than it was in 2018. So they just try to balance all of that out versus someone who bought one in 2026. They paid a lot more than what they would have paid for in 2018. So it's just trying to balance all of that out and make it fair, basically, is their explanation. So it's possible your taxes would go up. It's possible they'll stay right around the same. It's possible they'll go down. We don't really know until the new millage rates comes out, which is the end of the year here. So if you don't agree with your property assessment, can you appeal it? You can. Kind of a side note to this, we have a couple properties that got the reassessments, and I wasn't really expecting it, right? Nobody's expecting it, unless you're in tune with everything. So I got them, saw the assessed value, I was like, oh my goodness, my taxes are gonna go through the roof. And that's not really the case, like I was just explaining. But if you think that your property's not worth what they assessed it at, you can take it to the board and you can appeal it, not just based off of your opinion, but you have to have market evidence for the reason why you believe your property is not assessed properly or assessed at that rate. So just make sure if you're going to appeal it, make sure you talk to a local expert, realtor, attorney, whatever, and then have them get you some proof of why your property shouldn't be assessed at that number. And then just another side piece to that, make sure you have a deadline of 40 days from the time you receive that letter. That's on the mailing date. You have 40 days from that to appeal. So just time's ticking if you received it and you want to appeal it. Yeah, clock's ticking on that. Yeah, that about wraps it up for me. Thanks for your time. Hopefully that explains it a little bit more.
Awesome. Thank you, Ethan. Adam, how many of you got the tax reassessment letter in the past 30 days? Most of us here. How many of you have successfully appealed an assessment in the past? Cool. So for those of you that are wondering how to do it, maybe talk to one of those folks that just raised their hands. Cool. Well, super excited for tonight. The panelists, you can start working your way up here. The value of tonight's meeting is largely going to depend on you. So looking to you to bring questions. I do have a few of my own, but it's not enough to take up the whole evening. What I'd like to create here is a bit of a mastermind environment. And what I mean by that is what can happen in a group when somebody's asking a question is it'll spark a question in somebody else's mind. So when that happens, just hang on to it and share it when you have the opportunity. And you can get a synergy going and brainstorm ideas and thoughts you might not otherwise have had on your own. With that said, I do know what it's like to sit in a group and think of a question, but also thinking, hey, I'm going to look really silly if I ask that question. I can guarantee you none of these panelists here are going to think it's a silly question. We all started with, I think they would all agree, they started with, or would all confirm, they started with very little knowledge of real estate when they got started. So they too were asking what might seem like a silly question in your mind at one point. I don't know, maybe Darell always had it figured out, but I sure didn't. I'll start out with one question. John Mark is running Facebook Live. He's going to watch the comments there, so feel free to comment for those of you that are watching online. But after I ask my question, I'm going to open it up to the audience. So feel free to think about what you might want to ask. and share with the group. Cool. So I'll just say who you guys are, and then if you guys want to give a 2 to 5 minute introduction why you're super well qualified to be here, that would be great. So Darell Eberly is here on the end. Jeff Mohler is next to Darell. Benuel Esh, there second to last, and Ron Shepherd there on the end. So Darell, if you want to start.
All right,
and
thanks.
I'd like to take it from there.
Yes, I'm Darell Eberly, married, 2 kids, 6 grandkids. Can't quite believe that, but they say when you perhaps get started in something, it's either inspiration or desperation. I was desperate. I was 41 years old before I ever bought any real estate or investment property. I owned my personal property, but just other investment property, I never did that before. And probably like at least some of you, I would come to these kind of meetings and I was really afraid to ask questions because I thought I'd look silly. And I was always excited when somebody else asked the questions. Oh, yeah, good. But that was my background. I didn't really get excited till I read a book. And most of you have probably read it already. Robert Kiyosaki's Rich Dad, Poor Dad. And some people read that, some people apply it. And I was desperate enough to listen and apply it. And when they talked about owning assets as compared to trading time for dollars, I got excited. I wasn't afraid to work, grew up on a dairy farm. I wanted to see a light at the end of the tunnel, and hopefully it wasn't a train coming at me. And I was kind of sick and tired of being sick and tired and just trading time for dollars and spinning my wheels. We started buying apartments. Some of you know my story, but we purchased 29 rentals and flipped 16 houses the first year and a half. The total amount of my own personal cash to do that was $3,800. And because I came to things like this and I started hearing about private financing, I started hearing about seller help. And my first question is like, is that legal? I had never heard of that before. But you can grow at a much faster pace sometimes than the banks are willing to work with you with either seller help or private financing. So I'd certainly recommend that. Banks have their place. Personally, I think most bankers were standing in the wrong line when God was handing out common sense. Some of you would understand why I say that. But they have their place. They're happy to give you money when you don't need it. But learn private financing if you want to grow quickly. And I started out with apartments 7 or 8 years in, started buying self-storage facilities. We had storage facilities in about, 9, 10 different states. Sold some of them 3 years ago, pretty heavily into natural gas wells at this point. But I still have multifamily and self-storage as well. But that was kind of the journey that got me here.
I guess I'll go next. My name is Jeff Mohler. I love real estate. That's what I tell people. I fell in love with real estate in 1989, right out of college when I got hired as a title searcher for what is now Blakinger and Thomas in Lancaster City. I was always into investments, but I followed the stock market and the bond market. But then learning how to search titles, I fell hard for real estate, and I've never looked back. Just about everything I own is in real estate, so I believe in it 100%. I also enjoy talking about real estate and hearing your stories, questions, concerns. So I have been a title searcher. I've been an attorney. I've been a title agent. I've been a real estate broker. And now I do work with private lenders. So I've worn a lot of different hats during the years. I own about 10 properties myself. Then I have a partnership where we have about 15 with another person. And then I have a third partnership where we own property kind of all over the state. So yeah, just looking forward to talking with some of the experts. I've actually been through 2 real estate crashes. There was one before, the 2008 crash. Some of you might not have remembered that one, but it was the savings and loan crash. But then I thought about Ron Shepherd over there, and his dad was through the 1979-80 crash, which he kind of remembers. My dad was not into real estate, so I don't remember that. So we do have a length of years up here to shed perspective on the markets.
I'll give Jeff a plug for 1031 exchanges too. He probably won't even tell you this, but as far as value for 1031 exchange, I haven't had anyone get remotely close to Jeff. I'll tell you one. We had a deal recently where we traded 8 separate land parcels from a larger portfolio into a 1031 with Jeff, and then that became the down payment for a $9 million land purchase. And Jeff did all of that for $1,500. I don't think he would have if he would have known how much work it's going to be. But thank you, Jeff.
I was too cheap.
Probably won't do that one again for that number, but thank you anyway. So my path has been a pretty winding one. Darell mentioned desperation being what got him into it. It was a little bit of that for me. It's just, hey, how am I going to get off the farm? This is not what I want to do for the rest of my life. And so that led to how hard can selling real estate be? It turns out it can be pretty hard, but ended up working out well. And so my first kind of avenue in investing was building a multifamily portfolio, which that's been really fun. Would still buy more of that, although there's other things that I get more excited about now. I flipped houses for a while. That worked well, just became eventually not a great use of my time. And then later on, the last few years, a lot of time has been spent building a land portfolio. So that's where we've really had a bunch of fun. That to me is probably the most exciting version of investing now, and maybe we get to talk more about that this evening. But yeah, when you get to do stuff like what Jeff and I just worked together in the 1031, there's just avenues to grow that faster than anything else that I've gotten to be involved in. So it's been a whole bunch of fun. It's good to be here tonight. I look forward to the conversations.
Ron Shepherd, and I've been interested in my real estate my whole life. I grew up third generation. Is it on?
Do you know how this thing works?
Is that better?
Yeah, you should be good.
Yes, that's already up. Not working yet?
Yeah.
Okay. Maybe not enough. Ron Shepherd, I'm a third generation real estate investor. So my dad got started investing when he was still living on my grandfather's farm, and he went to an auction for a property that neighbored up to the farm, and he bought the property there. And when he went home and told my grandfather, just about kicked him off the farm. 2 years later, they bought a mobile home park together, and been investing in real estate ever since. But yeah, just a lot of history there with real estate. I've always been interested in investing in real estate, even growing up. I went to college, got my CPA license, worked in that for a while. Just had my own house. I was single and just didn't really care about making much money or doing anything. Took a lot of vacation, travel around the country, and then got married and started investing in real estate again. Eventually quit my CPA job, flipped houses, did a lot of sheriff sales, bought rental properties. Eventually got my real estate license, my broker's license, had a real estate company with Jeff Mohler for a while. And so I've been through a lot. I had a tax practice that I worked mostly with real estate investors for a while as well. I've been through a lot of things myself, also advised a lot of other people, saw a lot of tax returns. And when you do tax returns, you get to see the people that really do well and the people that really don't do well, but like other people to think they did well. You kind of get to read through the lines about a lot of things. But I've done like-kind exchanges, currently hold mobile home parks, some multifamily properties, several vacation rentals, and a couple out-of-state properties as well. And if I had advice to give somebody starting out, I would say the same thing I've always said: buy 1 to 4 property that you can get a 30-year mortgage on, lock your mortgage rate in. That's something that you know you can pay for, and you have it locked in. Just that's how most people build their wealth, is over a long period of time. We're talking about a lot of other things up here, flipping and real estate sales and everything else. It's all good. I've done a lot of it, done most of it, but a lot of those are jobs. They're work. It's not passive investing. Small properties can be very passive. You can have another job, do whatever you like to do while you're doing that.
Awesome. Then when you get really passive, you make a lot of money in real estate like Ron did and lend it out to other folks and just collect the interest checks. So.
Yeah, right now I mostly do hard money lending, and not necessarily my favorite thing to do. We still do some investing ourselves too, but we've been doing a lot of traveling the last couple of years. Back to when I was single, doing a lot of traveling around the country, and the hard money lending you can do it from anywhere. Don't have to be pounding nails and opening doors for people and stuff. So that's one of the reasons I'm that. And so I've encouraged everybody to do. One of the things I was thinking about coming here, like people ask me, how do you do this? Oh, what's the plan? What's this plan? What's that plan? And I've worked with literally hundreds, if not thousands, of investors, and I can tell you, you really have to figure it out for yourself. All of us up here have very different plans. Most of you have very different plans. If you talk to 100 successful real estate investors, they've all done different things. You can take, Benuel will tell you, you can take 10 different investors into the same property that needs a lot of work and stuff. Only 5 of them are going to even make an offer. 2 of them are going to make pretty high offers because they have it done, and it's because that property just fits whatever their experience, their style, their skills, their subs, whatever. It just fits that, and that's what you got to figure out is what it does. Last month, I know Joe said he was going to be here last month talking about his mobile home parks. Joe's kind of figured out that's his niche, his mobile home parks. That's what he's real good at. Darell knows self-storage really well. He's done really well with that. Benuel's doing land. Jeff does a lot of different things, but he's done real well with small rental properties. Done really well with those, just holding on to them and just letting the equity grow.
Good stuff. Yeah, Ron, you touched on this a little bit, but the first question I'd have for you guys, so somebody just starting out, they have 30 to 40,000, they want to invest. How would you suggest they approach it? What should they be buying? What should they be thinking about? Darell, you can start. Yeah,
Maybe go into pharmaceutical sales? No, I'm kidding you. No, a lot of it depends on your goals and where you want to go. Most people starting out don't have that 30 or 40,000. And if you're in that boat, I can relate. However, if you do have that 30 or 40, I like what Ron shared there. There is a lot of different options on directions you could go. But for me, I never considered myself necessarily a creative idea guy, but I learned from people that were way smarter than me. And I would come to these kind of things and just be a sponge, and I would always ask questions later on, or I would buy a lot of guys breakfast or something, that kind of thing, and I would ask them specifically, if you were in my shoes, what would you do? And sometimes I'd hear different options, but you're going to find an area that kind of appeals to you, whatever that might be. But it's hard to beat starting out residential apartments. That was the direction I think a lot of people start out in. It varies sometimes, but it's hard to beat putting some money down on that and getting that working for you. But time's your friend owning real estate. It really is. But the key is just get started. Whether you buy it you take that 30 or 40,000 and use that money to put down on a 3-unit building or something like that, 4-unit building, either way, my recommendation is just get started, do something. You're going to learn more just as you're in the game than you will only things like tonight. You're going to learn just in the process of being out there swinging the bat. And once you get your first one bought, you'll have little ideas you might do different next time. But some of you see that as a problem getting started in it. I have a little 3x5 card. It's been up in front of my desk there for probably 15 years. And it says, problems cannot be solved at the same level of thinking that I had when I created them. You're here tonight because you want to learn and have ideas. Some people see problems starting out. Some people see solutions and opportunities. It's all the way you look at things. And the guys that often win, they just approach things different as far as buying a particular property. If
I had 30 or 40, I think the way I got started was I had a lot less than that. But I did have a dad that lent me $10,000. It wasn't Donald Trump that got a one-time loan of $500 million to just start out with to invest in Manhattan real estate. But I did get a loan of $10,000 to cover closing costs to buy a 2-unit. And my wife and I moved into the second floor unit and rented out the first floor unit. So that's how I got started. Now, if you're Amish and you have a horse, I couldn't really stable a horse in the backyard of a city property. But yeah, my second thought would be to buy a townhouse, a post-1978 townhouse that you don't have to worry about the lead paint issues. And just keep that. We up here, between the 4 of us, we own a ton of real estate, but the fact of the matter is most people that want to get into real estate only end up owning 1 or 2 rentals. And the burdens and the challenges overwhelm them at some point, and that's all they buy. So I would buy an easy-to-manage townhouse, something that's not going to cause you a lot of problems. If you buy in a rough area in Reading or someplace, that's probably going to knock you out of the game. And there's a lot of benefits, so try and get something easy right out of the gate and go from there. Time is your friend, like Darell mentioned. I have one, it's actually one of the first properties that I bought. I'm probably going to sell it this in about a month. Bought it for $32,000, a townhouse in Lancaster. Or it was in 2000, so it's going to be fully depreciated this year. And I'm thinking about following my own advice, selling it, and moving out of the city into a nicer, much newer house.
How much are you going to sell that $32,000 property for?
We will see.
Best guess, Jeff.
You know a good realtor.
Yeah, I'm hoping for 150. Yeah, it's not a bad house. It's just dirty and kind of worn and tired.
One of the really interesting things about that is probably almost all of that appreciation happened since 2016. Maybe not.
Yeah,
You
probably
get
so.
some increase
Yeah.
there, but most of it's
Yeah.
since 2016, because I literally have purchases from 2016 that would have made that same kind of jump. So it's kind of crazy. These last 10 years have been fun.
Been a great market.
So I love what both Darell and Jeff said. I think those things are great ideas. I think a fair thought in the beginning is, I think the goal should be, how can I become the most valuable person I can become, and start with that. So if you want to be in real estate long term, or if you think you might want to be, I think these things are a great way to start, because the most value you're going to get out of that first deal is what you learn out of it. Even if that deal ends up being a home run, the experience is going to end up being much more valuable than any money that deal could make you. And like, it's so hard to there's no way you can predict in the beginning where this could all go, right? But if you start with the goal of, hey, I want to learn this arena really well, then the only way to really learn it is to get into it. So whatever you got to do to get in. And if you're starting with 30 to 40,000, you're starting with more than most of us started with. And you don't have to wait until you have that either. Like, you're really, in business in general, but especially in real estate, you're really only limited to the value you create and can bring and your creativity. There's not much more to it than that. Who could predict that you start out with a dirty rooming house, and then years later you're doing deals at numbers you could have never imagined, whatever, 5 million, 10 million here. And then that would lead to being valuable enough that you can get a large chunk of the equity in a $100 million land portfolio. Like, you can't predict these things. But the key is to get started. And if I had that 30 to 40,000 and you think you might want to be in real estate, I think what Jeff said is a great place to start. If you can live there, you can get an FHA loan, maybe do 3.5% down, 5% down, and it stretches that much further. So it could be a great strategy. But I would start with, where do you think you want to be most valuable in the future, and work backwards from there.
Yeah, I run into this probably at least once or twice a month, and somebody has 20 to 40,000, and a lot of times what they do is they go buy a property that needs to be rehabbed a little bit. They can rent out to cover a mortgage. If it's going to be worth $200,000 when it's all fixed up, they know they can borrow somewhere around $150,000, $160,000 from the bank. So they can buy the property for $120,000, put $40,000 into it. They can go to the bank and get the money back. So they can have their $40,000 right back and do the same thing on another property and just keep rolling it. So that's another option to think about. Jeff or I would be happy to help you with that. You have $30,000 or $40,000 to look into that. But Lancaster City is probably not the best place for that anymore. It's a little high, but York, Harrisburg, Steelton, anywhere at Lebanon, anywhere a little bit more out of the way a little bit, it's probably still a possibility under the $200,000 mark. So.
Cool, thank you. I do have more questions, but would really love to have some questions from the group. I don't know if anybody has anything burning they want to ask the panel here.
I have one question.
Go ahead, Daniel.
So let's say you would have 30 or 40,000. Instead of investing that in real estate, start a small business, grow that business, and then have that business cash flow to buy more real estate. What's your input on that?
So I'll just repeat it so the folks watching on Facebook can hear. So I'll summarize here a little bit. The question is, would it be a better approach to take that 20 to 30 to 40,000 and start a business that generates a lot of cash flow and use that money to invest in real estate versus jumping right into real estate? Is that a fair summary? Okay. Yeah.
Yeah, absolutely. It's a great way to get started, especially if you have some skills and so on in that particular business area, or a partner that does. So if you can do that and have that generate some cash to put deposits or whatever down on long-term real estate, wonderful. That's, for me, I was desperate. I wanted that cash flow for real estate, so I was focused mostly on the cash flow. And milking cows didn't pay that good.
Yeah, I've heard that from a number of people, that milking cows doesn't pay very well. I think that gets back to where we were talking about each individual person having a unique plan. If you have the skills and the wherewithal to start a business and make it a success, I would say probably go for that first before investing in real estate. The vast majority of people that get into real estate keep their full-time job and do real estate on the side. So that makes a lot of sense to me, because if you can go from a $25 an hour job to, I don't know, $50 or $100 an hour as the owner of a business with employees, you're going to generate a lot of cash to invest in real estate.
Yeah, I think it goes back to where do you think you can be most valuable, right? The other cool thing with if you can create a business that spins off a bunch of cash is where real estate is arguably the most powerful is if you have a tax problem, right? If you can figure out a way to be a real estate professional, which most guys that are married and running businesses, their wife might be that. There's lots of ways to do it. Now you can take that the first year where you crush it and you make $1 million and you're looking at a $350,000 tax bill. You can literally go buy, at least talk to your CPA about these numbers, but you could literally take that $350,000 tax bill, use it as a down payment on the right kind of property, do a cost seg study, and pay zero. Your down payment could literally be less than your tax bill was. So that's where real estate becomes just incredibly fun if you can marry those two together. So yeah, I would be if you have something you're passionate about and you think you can figure out how to make money in it, start the business first.
Yeah, I would pretty much agree with Ben. If you're passionate, you have skills, and you have a business, you can go after that. But again, if you put $40,000 into a property and you get it back out in a couple of months when you refinance, you still have that you can put into business.
Yeah. You can ask yourself a question. If you had a source of private financing that just sold a farm and had $1 million to put in, he said, "Yo, I trust you, I'll work with you, you can put it into real estate," would you start a business? Is your limitation only, do I have the cash to put into real estate? So where I was coming from, 41 years old, sooner or later you get tired. And man, this thing is approaching, there's a lot of time went by. So I figured, because I had a sense of urgency, I wanted to grow quicker. And so I focused on buying the real estate and focused on that monthly cash flow. But I had a limitation in my thinking that I can't buy because I don't have cash. So.
Good stuff. Russ, go ahead.
What is a regret or a mistake that you made that you would never want to do again? What was a failure or something that you never?
All right, so I'll repeat the question. So the question was, are there any mistakes, failures that you have made in your life,
Well,
or in your real estate journey?
what lesson did you learn from
Yeah.
your failures, basically?
Okay. Are there any particular failures that stand out to you where, if you could, you'd go back and change?
Managing my own rental property of 65 apartments downtown Lancaster City myself. So but I understand why I did it, because on the farm, you don't hire stuff out, you do it yourself. But I didn't understand the value of my time. So.
Early on in my career, I was buying a couple properties, and I didn't have very much money. And I was a little bit afraid of what would happen if something bad happened at the property, that the HVAC went out. I wouldn't have enough money to replace it. So I brought my dad in as a partner. And we still own those properties today. They're both paid off. But I think he showed up to paint one time and stayed for a couple hours. And that was his extent, other than the financial backing in the early days. But those properties are, they're probably worth $400,000, and he's got $200,000 that I just gave away because I was too afraid, really. Yeah, you want to conquer your fear, but at the same time, some things are for real that are bad, and you do have to have a plan to deal with those if, in fact, they occur. But yeah, I was just all the properties I sold. I kind of wish I'd have had everything. I probably sold a few that I should have held on to.
These are not terrible regrets to have. I would like to think you brought your dad in and gave him that money because you love your dad, right? It wasn't because you were afraid. You love your dad. But yeah, I would pick on Darell on the property management side a little bit too. I did the same thing, held on to it for too long. But instead of handing it off to a third party, I built the systems and then brought someone in-house to do it that way. So you have the whole spectrum of options there. But the problem with handing it off to a third party is I have yet to find someone that cares about my properties remotely close to as much as I do. The alternative is build the right systems, plug in the right person, then you just need the skill to make it worth it so you can pay a good person. So there's a balance as to how that all happens. I don't know that this is even really a regret because we all have our journeys and we all get to where we are. But if I could go back and change things, I would just think bigger sooner. We all start somewhere. I just spent the first 5 years with single-family homes here, small multifamily there. And in hindsight, I had the ability to go out and do the things we're doing today. I just didn't know it, didn't have the guts to go do it. Yeah, probably didn't have the knowledge that some of this stuff is even possible either. The other thing, I did some partnerships early on. It's just that, when done well, is probably the most powerful thing you can do. You learn where your limitations are, find someone else that is really good in that seat. I could pick on Jake all evening on this. Jake's a partner in the land deals and is really the glue that holds so much of it together. And it just wouldn't happen without him. And so you find the partners that are really good at some of the things that you might not thrive in, find someone that's amazing at these things, and you can go to levels that you never could have dreamed of otherwise. So just learn those things earlier is what I would do.
I would buy more and sell less. Like I think some of the other guys said the same thing. Time is your friend in real estate. If you get bad deals, time will correct most of those bad deals. But again, that's why small properties that you can lock in 30-year mortgages are really good because then you have time. If you get I have a lot of people right now that I know that are calling up. They got mortgages early 20s and they're coming due. Commercial loans 5 years later they're coming due. And they're looking at their rates just about doubling. And I have one that's coming up the end of this year, but I expected it to double. But a lot of the people did not expect it to double, and they're like, now what do I do? And pretty limited options if you don't have cash to throw into it, and you're not cash flowing well. Yeah, but really just buy more, sell less.
Great question, Russ. Thank you. There was a question over here.
Back to the business question. Isn't that just what Darell did? He started a business, but business with real estate.
So the question was, go ahead, I'm sorry.
Real estate or anything else. Darell collaborated on that.
Sure. So a question for Darell was to piggyback on whether we start a business or invest in real estate right away. The question is, did Darell technically start his business, but the business was real estate? Is that a good summary? Yeah.
His question about starting a business versus investing in real estate is kind of what Darell did. He started a business.
But the business was real estate.
Sure. Yeah, the key thing, and I didn't recognize this in the beginning, to be fair, but the key thing and why I answered that question that way, I like to begin with the end in mind. I was so busy putting so many hours in, and there was no such thing as an ongoing income from my efforts. And the idea that I could do the work once and get paid every month the rest of my life, including my kids and grandkids that I haven't met yet, just fascinated me. And I just wanted to do something that would stay done. The cows didn't stay done. And so that part of, I know of people that own a great business and very profitable. However, they're on the treadmill too often and they can't get off. I like to hunt too much. So to me, the older I got, I valued the time far more, and the ability to have professional management or somebody take care of things. It doesn't mean I don't pay attention and watch it. However, that special thing, real wealth is free time. It's not money. But you have to have a system in place that can create that. Have your money working for you instead of trading your time for the money.
Good question. Thank you. All right. I'll let you think about that a little bit. So I had somebody give me a call, I believe last week. They weren't able to make the meeting, unfortunately. So the question was, so they flipping their first property and it did not go as expected. And his question was, I'm trying to think how to frame this in a way that makes the most sense. His question was, is this a sign that this is not my gift? Should I just stop here while I'm where I'm at instead of digging a deeper hole? Any thoughts on that?
Emphatically, absolutely no. It's tuition. It's tuition. He learned something that he's probably not going to make that mistake again. But no, it just means he learned something. It doesn't mean that your perception on how you see failure has a big factor in where you're going in life. Do you see it as tuition? Hey, I learned something. I'm going to be better next time. He's probably asking better questions now because of what he learned. So I'd say absolutely not. That's no sign that, hey, he can't do real estate. No way, shape, or form.
Did any of you want to add to that?
There's a lot of people who fail at things and go on to become experts in their field. So I think it's just, like Darell said, a lot of it's learning, but it really comes down to the person, and it depends how, like Darell said, how they treat it, and it depends if they can actually learn from it or if they repeat their mistakes. I've seen way too many people that they seem to learn for a short period of time, but then they eventually just repeat their same mistakes and go back to their old ways. They never really kind of get out of that. So that's the challenge, is you have to, it's like habits. You got to break those old patterns and habits.
I lost money on my first flip. It was the only piece of real estate I ever lost money on. I think you
Good
keep
answer.
going, probably.
I tried flipping with 2 different guys, never really made any money at it, and finally just decided that was probably not the thing to do. What's the definition of insanity is doing the same thing expecting different results. And so I wouldn't say after one time give it up, but after 20, you either need to change your habits really fast or move into a more productive area, something that you are good at. And I did have the money or ability to make money in other areas, so why not do those things? And yeah, Russ wants me to expand on that, how I shifted gears, and that's correct. After I stopped practicing law, I tried a number of different things, and one of those was flipping. Another one was expanding the buy and hold. And then the other one was expanding the hard money loans. And I'm still doing 2 of the 3, just stopped the flipping. I just didn't know enough about construction, honestly.
Yeah, but you knew enough to lend to other flippers. I'm trying to pull out the positive from it.
Oh, yes, I've been pretty successful as a lender.
But just because you failed, I guess my point was, just because you failed at that, it shifted, you pivoted to a thing that was so good for you. So even if you sucked at one thing, it leads you to the thing that you don't suck at.
Yeah, I would agree with that. I just had to find something that I was good at and could make money at, and eventually found those things.
So now you look to not lend to flippers like yourself.
Yeah, I do root for my clients or borrowers to be successful. I only make money if they make money in the end.
Good stuff. Go ahead. I see a hand there in the back.
Yeah. How does hard money lending work? So let's say, I appreciate the business question. You start up a business, you're early stages, you're minorly in debt, could probably borrow a little more if you needed to, but could do so much more as well. Is the thing to do to go out and do hard money lending outside of the bank, or
Yeah, so I'll repeat your question. Let me know if it's a good summary. So the question is, how does hard money work? When is it appropriate to bring it in? Or when you just be a little more patient? Do you want to start, Ron?
Sure. Yeah, I think it just depends on everybody's circumstance, and some people want to move ahead faster, so they don't have the money, so they want to take a little more risk. Really, what it is you're just paying a higher interest rate, maybe some more fees, so you just have to get a better deal, and you might have to take a little smaller cut early on in some of those deals, but you can do a lot more deals because you don't have to have all the cash yourself. You don't have to borrow the money from the bank. And as all the agents know, you can actually get deals because if you go for bank financing, you're looking for 30, 45 days minimum. Hard money lending, we're settling usually week, 2 weeks. Somebody that wants to get rid of the property quick, you can actually get it. As far as waiting until you have the money, a lot of people are never going to have the money if they have to wait for it. So have to wait till they save it up. It's like people waiting till they have enough money to afford to have kids. You're not going to ever have kids. Wait till you can afford them. Yeah, I think a lot of it depends on your risk tolerance, your skill set, and again, being able to find properties that the hard money lender will give you enough money on. Somebody who should not be doing hard money loans is somebody who's never been able to save up any money, probably. If you don't have any of your own money invested or that you can put into the property, it's probably that's not going to work out well. You might get one or two, but there's probably some other things there that you need to work on before you try to borrow hard money.
How about you, Jeff? Any thoughts on that?
Yeah, the borrowers that I'm looking for do have some money to invest in the deal, and I do some aggressive financing, but generally I'm liking to see some equity come in from either themselves personally or from family or friends. I don't want to just be the financing of a dream. That's not good business. And in the more or less distant past, I've done that and regretted it. When I went back and looked at the deals that went bad, a person that doesn't own their own home is generally a bad investor. And so I've made it a rule now, except for young Amish guys. If you don't own your home, I just won't do business with you.
Ben or Darell, did you have anything you wanted to add? You don't necessarily have to, but yeah. Okay.
I'm curious was that question just framed around if you want to go buy a piece of real estate or borrowing money in general?
So I build cabins, and they're amazing Airbnbs, and I'm like, I should be buying properties to put my cabins on it like my customers are. I could grow faster that way rather than waiting to have enough cash to do that later on. How to find someone to come behind you and do that.
I think all you need to do is call me or Ron and talk about your dream. Yeah.
Yeah, I do think that there's a little bit more to that. You have your system right now for building those, but you're going to have to build a system like Benuel did to be able to manage all those properties on all the land. Make sure they get rented out, make sure you actually get them filled so that you get the income. And that's what your clients already have that are buying them. They already have those systems in place that they can get the renters to come, stay there.
I'll just throw in a kind of fun bone to that. So there's really inexpensive land out there that does really well as short-term rentals if you put the right thing on it. One of the things that Jake and I have done together is we own, 13,000 acres in western PA. We just tried it as an experiment. This is land that we paid anywhere from $1,000 to $3,000 an acre for. Let's put a cabin up there because there was an old lodge that burned down and the infrastructure is there, and they have crushed it. And so we built more. So I'm just saying that to say you could go to a part of western PA or there's plenty of other inexpensive areas out there. Buy yourself a 5-acre parcel for 20 grand. They're out there. Put one cabin on it and see how it does. You don't have to start with anything elaborate or crazy. And it might just blow you away. And that could be the starting point of a lot more if you want to go there. So a lot of times we just don't do things because we overcomplicate them. And if you're building this thing, you're probably doing it for far below what the market value is. And so you just got to take the first step. And your first step could actually be a really simple one. Hopefully it involves Ron or Jeff, but there's probably ways you could finance it with a bank too. So it's just a matter of how creative you're willing to get.
But yeah, back to your question about hard money. The reason people do it is because they can accelerate how fast they're doing it. And that's the same thing, sounds like you're looking at, is rather than waiting till you make enough money to buy property, how can you get the property now? And there are people that, just like Darell did in his first year, he couldn't have afforded to do one property on his own really, but if you do private money and you can buy them and sell them fast. I'm working with people who are doing 10, 15 properties a year right now, every year, and they just keep rolling them and they move them quick, and they have crews that get in and knock them out quick and just keep on going.
There's no such thing as a money problem. It's a wisdom problem. Just the way you think.
Good stuff. Go ahead, Kevin.
Market cycles. You just talked about the last 10 years were more appreciation than the last decade versus the prior decade was more appreciation. Since there's nothing new under the sun, what should we learn about prior cycles? What could we easily expect? Or not, I shouldn't say easily expect, but what could tend to repeat itself?
Yeah. The question is, based on past market cycles, what can we expect in the near future? Is that, should I reword that?
Correct, because it doesn't go up in a straight line.
Where are we at in the cycle right now?
So what can we do to make holding it a safer bet so you don't get into commercial mortgages doubling and people have themselves stretched?
Make sure we're not buying in a bad time of the cycle. Yeah.
Some of that has to do with incorrect assumptions when you originally buy the property. People that assume, hey, real estate always goes up in value at the same pace every year, and they forget that the market does go in cycles. I might answer that question with a question. Is the Federal Reserve going to continue to bail out the economy by printing dollars going forward if something happens to the economy? That might be the question I would ask as far as, and is that going to happen? Is the sun going to come up tomorrow morning? Yeah, that's the way they operate. So the next time there's a cycle, it'll go through cycles. It always does, always will. But when that does happen, the thing to own is real estate. It's an awesome investment, but that's the method that the Federal Reserve operates by. When they get into the jam, they print money and lower interest rates. But don't assume when you buy something that, hey, this will work out because interest rates are definitely going to come down. No, that's where people get in trouble. So don't make those assumptions. It's got to work at the interest rate today. And if it happens 3 years down the road, interest rates are lower and you can refinance, just make sure when you buy that property, you've communicated with your lender, hey, can I refinance? And that there's no big penalty for refinancing. That's a big one.
Darell, when you got your first mortgage on your personal property, what interest rate did you pay?
It was 7 3/4.
And how about you, Jeff?
I don't remember, literally.
Mine was in 1994. My first interest rate was 9.25%. I refinanced a year or two later for 8.5%. I thought I was doing amazing to get that. So these interest rates that we have and we've had are just incredible. I don't know that they're going to go back to those, but just from a long-term perspective, the interest rates even at 6%, 6.5% are still low. And that's what back in 18, 19, 20, 21, people were like, oh, we're doing this property and we're being really conservative. We think the rates might be at 5% when we refinance. And it was like, that should be what you expect anytime. That's not being conservative at all to expect 5% interest rates. So that's a lot of the reason that people got into problems are. But anyway, 100% of my predictions will be wrong. I can guarantee that about anything I say about what the real estate market may or may not do. But I remember I was a kid. My dad had rental properties, like Jeff said, 79, 80. And he was happy just to have tenants in the properties that were paying the utility bills, so he didn't have to pay utility bills. Getting very little rent at the time and stuff. And there was a lot more supply than there was demand at the time. The economy was bad. People didn't have money. We're in a very different market right now, and we're going to be in a very different market for a while because there's not enough supply. And there's not going to be enough supply. Even if they pass a new housing bill, it's still going to be a couple years out at best. And even that's just not going to reach the supply of what we need. They just haven't built enough houses. So that's where you go, tiny homes and stuff like that. They're going to get more of those more multifamily. You're going to see some single-family houses getting torn down, multifamily properties getting built. But as far as how do you predict, how do you work against that? You have to expect that bad things are going to happen. And again, the 30-year mortgage rates, they don't change. They don't change in 30. Commercial loans are usually 5 to 10 years at the most, and then they change to whatever the market rate is at the time. If it goes down, you're doing well, but if it doesn't, you're not. You get a 30-year mortgage. Last mortgage I got, 30-year mortgage, I got 3%. I got 21. I got 3% mortgage on a vacation rental property. And all I have to do is pay it down over 30 years. That's cheap, very cheap money. So why would I pay that mortgage off when I can go put it in CDs making more than what I'm paying in interest? But yeah, as far as market cycles, just be overly conservative on what things can happen. 2006, 7, and 8, I was working with flippers during that time, and I had my real estate license, and people were trying to sell these properties, fix property up, and they were trying to sell them. They bought it before the crash or whatever, and they'd put it on the market, and they put it on the market for $100,000, and they're like, it's not selling. And it's like, no, because there's 20 houses for $100,000. They're like, well, what's it going to take? And if you got to go down to $95,000, and you have to have somebody sells it before all the other 20 properties go to $95,000, because as soon as they do, you got to go to 90 because people are in a hurry. Right now, you put houses on the market that are in good shape, and you're going to have multiple offers in a couple of days. Back then, you had buyers. There was no urgency for a buyer. There were 20 properties to look at the same price, and they knew that the next month there were going to be 25 properties, and everything was going to be lower than what it was. And so when you run into that, the people that took the advice to drop the property and sell it and get out of it what you can and move on did well. I had a builder I was working with at the time that gave the same advice. He had a bunch of lots. He could have sold the lots to other builders early on. He didn't want to sell lots. He would have taken a small loss. He waited 2 years later. He lost the entire business. He's not building today. He's working for somebody else. It's just he wouldn't take the advice of people. He would ask advice, but he wouldn't take it. So when you get into those times too, you got to ask people what's advice. Somebody that's not directly involved in the profit of what you're doing, directly involved in the investment. You have to ask outside people. I give everybody the same advice, and some of the people took the advice and some of the people didn't. And the people that took the advice are, for the most part, still investing in real estate, and the people that didn't take the advice are no longer in real estate.
Good stuff. Yeah. So what's going to happen in the next 10 years, 20 years? We have no idea, right? And I do think trying to time the market is probably a fool's game for the most part. I wish I knew what was going to happen in the next 10 years. But on the other hand, any of us that tried to predict 2020 and the COVID boom, like none of us saw any of that coming. But if you were invested, the heavier, the better you did. And those surges are going to come. The opposites are going to happen too. We're going to have downtimes, which is where you just need to be a really skilled manager at the end of the day. This is a cool story that just played out not that long ago. Kind of crazy numbers, but maybe nobody here follows basketball. But there's a really cool kind of business story that just went down there. Back in, I might completely butcher these numbers, but I think it was back in 1968, this dude bought the LA Lakers for $110 million. He sold them last year for about $6 billion. So 1968 through last year, $110 million to $6 billion. Here's the crazy part of that story. If he would have put that $110 million into the S&P 500 and left it sitting, he would have actually done better. That stat blew my mind. You can Google this stuff. I'm not sure what the original purchase price was, but it was like the numbers looked nuts until you looked at, okay. So the lesson there would simply be just buying great assets and letting time do their thing. Like when you bought becomes completely irrelevant over a long period of time. So I think for those of us that want to build wealth long term, it's just be consistent with buying good assets on a regular basis and just keep going. Some of us are going to run into walls like Ron did and realize, okay, this one thing that I'm doing is not a great idea. I'm sorry, Jeff. I did the same thing, flipped houses for a while. It was moderately successful and just eventually decided this isn't what I want to do. So it doesn't mean that we continue to do a dumb thing. But the way wealth is built long term, if you look at every single one of the wealthiest humans on the planet, they just built something consistently for a long period of time. Some of them, it's businesses. For some, it's real estate. There's some, it's in the stock market. It doesn't matter. It's just about being consistent with something that you're passionate about and good at for a long period of time. And timing is irrelevant in the grand scheme of things.
And I would echo what Warren Buffett's one of his favorite investment maxims is don't bet against the United States. He believes in being generally long and invested in assets. Although even he has built a portfolio of $300 billion in treasuries right now. He's a net seller of stocks. So even he has to change investment philosophies sometimes.
I agree with Benuel. Just get in the game. Get in the game. What was the average profit that you made of the house that you almost bought?
Good stuff. So Benuel, I'll start with you. I'll lob this question at you. Partnerships in business, investing. Any suggestions? Would you recommend them? I think I know that answer, at least from you, Benuel. What are some things you would put in place before starting a partnership? What are some things you look for in a partner? Yeah, I'll start there.
Yeah, I've been a part of a whole bunch of partnerships. Not all of them have gone incredibly well. None have ended terribly, probably in large part because of having the early hard conversations. What happens if this goes sideways? How do we disband it if in that scenario? And these conversations don't have to be that difficult or complex. There's a simple set of rules that we all agree to, right? We all go into them thinking we're going to accomplish incredible things together, and sometimes it will be the reality. Every once in a while, it's not going to be. So I would say what I look for in partners is probably first character. If you can't trust someone, you're not going to have a successful long-term business together. It is what it is. And then the other piece would be whatever I don't have, I look for a partner to fill that slot. So sometimes it could be, if you're brand new in the business, what you have is time. What you often don't have is money. So if you're willing to put in the time and get really good at something, there's plenty of money out there for you. If you become the person that can bring the value and you're willing to put in the time, there's plenty of people out there that can fill the rest of that bucket for you. Then eventually, as you go down that road, you'll probably become the person with the money but don't have the time, and so you might look for the inverse of that. You'll get into some complex things like our land deals. I'll pick on Jake here again. Someone needs to be the organized, the cool head, someone that's just really good at a variety of things and keeping them together. That's Jake. That is not me. So, I literally have a team of people that helps me keep my life together, and I need every one of them. And then in that larger, more complex partnership, if you will, there's a money guy. That's also not me. I can contribute, but not at the level that we need them. And then there's a guy that knows timber, which I still don't know trees from trees, a poplar from an oak. It's pathetic, but I don't need to, so it's good. So yeah, look for character. Look for the things that you don't have that someone else can provide.
I've had 4 partnerships, one with my dad and 3 other ones, and character and a complementary skill set so that they can do things that you can't and you can do things that they can't. One thing I would add is that hopefully they're financially solvent. The best partners that I have are worth 7 figures plus, and so first of all, that means they're generally good business people, but also when one partner has a lot of money and the other one doesn't, it's just not going to last very long, normally. The person with no money generally gets jealous of the one that does have money, thinks that they're taking too much of the profit, and something ruptures there, and generally they split up.
Yeah, I would definitely say always spend more effort or time or energy understanding or knowing the person than you do the deal.
That's good.
And don't forget, it's a lot like marriage. It's easy to get into and really hard to get out of many times.
You want to add anything to that, Ron?
No, I would just say a lot of partnerships do not end well. Doesn't mean they end disastrously, but they don't end well. But shorter term periods, like Benuel said, knowing how you get out, having a way to get out. If I go into a partnership, I want silent partners. So that's what I like, because And probably I've not picked well. Good partners is probably part of the problem. I want that, but based on some of the people I've had in the past, and some of that's family that just aren't as interested in real estate. So I would say that's probably a big part of it too, is that the people you go into partnership with have to be interested in what you're doing. If it's nice to have somebody with a lot of money, but like Jeff said, if they have a lot of money but they're not interested in real estate, and you're interested in real estate, they're going to get distracted or they're going to get tired of it and they're going to want to move on.
The beauty of identifying private financing that can finance your deals, I was able to keep 100% of the equity. In 10, 20 years, that is massive. Makes a huge difference. So that's the other side of identifying. Partnerships definitely have their place, but I have a number of them today. But the beauty, starting out, if I'd have given 50% up of the equity of the apartments downtown Lancaster, that's a chunk today. So something to think about.
And you got to remember goals change too, especially if you're young, you're not married, and you get in a partnership with a couple of friends. All of a sudden, a couple of years down the road, and everybody's married and has kids, and everybody has different priorities and different goals for lives. So things change. So it's not always that you pick the wrong person or the wrong thing. It's just that things change. So again, shorter term partnership, doing a flip together, you can find out whether or not you can work with people. It's pretty short term. Something like that might be a lot better idea than buying a big commercial building that you plan on being in with somebody for 20 years and then 5 years down the road realize it's not really working out and trying to figure out how you can sell out or buy them out.
Several lots.
So Eli handed out a lot map here, and I guess to summarize the question is, if you own the deal, how would you maximize the value of this lot?
This is in Reinhold's, correct? So you could break this up as single-family residences, and the floodplain would then become more valuable as someone's backyard, arguably. But this is you maxing out the lot as far as occupancy on it goes, more or less, yeah. It's hard to beat owning something like this long-term versus just making a quick buck on flipping it.
Yeah, opportunities like this don't come along all the time unless you know how to find them, which you do, Eli. But one thing that I like about this unit is that if things don't work out, you can always condo it and then sell the units off as individual condos. So I always like to have a way that I can get out of a deal if I need to. And so both this project and the one that you have in Columbia, the same thing applies to that. And now is to how to squeeze more units out. I'm totally worthless on that. I wouldn't pretend to know.
It's not so much that as I'm kind of a landlord mindset here, and I've got a one-track mind. I want to own some nice rentals. But with the housing shortage, could I do better? Subdividing it into maybe 3 or 4 single-family lots that are bigger, nicer, or some other use, but I'm not thinking.
You're talking about two different types of things. So buying this and subdividing into lots is really more of a business than investing. And I know your heart is really in long-term investing, rental properties. And if you want to own new construction townhomes in or around Lancaster County, you should keep it because they're too hard to find. You're not going to find much land like this anymore. And the existing stuff, you're gonna pay a whole lot for. Just knowing you and where your heart is and what you want long term. If you want to own if you want to own townhouses in or around Lancaster County long term, I would keep it. Build the townhomes. I would get as many units on it as you can. If you can do garden apartments, one first floor unit, a second floor unit, something like that. And parking is going to be your limitation on that. And I would not overbuild the units, 2-bedroom units. Probably don't need 3-bedroom units, and I would plan on keeping it. And by the time it gets to the point where you need to condo it or you want to sell it, somebody else can worry about what they want to do with it at that point. You'll have gotten out of it what you want.
It's all or nothing for Eli. I'm curious if you've thought about what Ron is suggesting with apartments versus townhomes. What led you to townhomes? Yeah, and one of the interesting things with townhomes is one of the biggest developers in our area, Joe Deeren. I've seen him come up with, he'll run all these scenarios, right? And I've seen him come to the conclusion more than once now that they might have this scenario where they can either build 100 townhomes or 250 apartments, and he'll go townhomes most of the time as of late. A part of that reason is there's no common areas with townhomes. That's actually a big part of how he comes to that conclusion. And then it's just, where's the market? Is the demand for 3 and 4 bedrooms with a finished basement? And in some of the Lancaster, York developments that he's done, that's been the conclusion. That's what the market needs. Because everybody else is out there building efficiencies and 1-bedrooms, and there's a gap in the market. This reminds me a little bit, too, of, I think long-term you probably end up in a similar spot. I have a really beautiful 9-unit warehouse conversion to apartments in downtown Lancaster. And what's happened in the 4 years since we've developed it is values for condos have outpaced rents by so much that now I'm sitting on a building where the average rent is $2,000 and the average condo is worth $350 to $400. So at what point do you condo it and sell it because you just can't justify holding it? You may end up in the same spot here, which is a really nice problem to have because you hold it, your rents will probably continue to go up, they'll probably continue to be worth more. So yeah, it's hard to beat hanging on to something like this if you're in a position to do it. So I'd love to give you something that's just earth-shattering, but I think you have a good thing going on here.
In the current market, to answer your initial question, the current market, the highest best use is probably either selling the townhomes or selling the single-family lots, just because prices are so high compared to rents right now. But just knowing what you're looking for, what your dream is to have, this is a pretty good property for you to keep.
And then one final question. This is for Darell specifically. Could you join me at the next township meeting if I need?
I might be to your detriment.
Kevin, you had a question.
For Eli, what do you expect to spend per unit and what rent?
The cost per unit and what rent are you getting is the question.
Cost per unit is probably going to be right around $240, $250.
Wow.
That would be everything: land, utilities, running utilities, all the excavating work, and then the actual building as well.
What do you expect to get for rent?
We're not sure. I've never rented anything in my homes. I would just guess. 2,100. I really don't know.
Cool. Winding down.
This year, 10 years from now would be something different.
You're violating the 1% rule. You're cool with that? Yeah.
Would it cash flow? Those numbers?
It will remain.
Cool. We have about 5 minutes if anybody wants to. Go ahead, Sam.
Yeah, seller financing. What's the best way to present seller financing to an older lady that just wants to get rid of property?
This is a live scenario, right? This is one you're dealing with. Yep.
So I have a lady that presented me. She has 4 properties. She wants to get rid of them, and she's not sure how to justify. I know it would work really well for her to go seller financing because of capital gains and such. But I know from previous experiences she's a little trust savvy. So I'm going to present seller financing to her. I just want to know what's the best way to take that, and what are things you do not say in the beginning.
Identify what she needs or wants. Ask lots of questions to really determine what's important to her, and then cater your offer to that.
Just for our online folks, the question was how to best present seller financing, the seller financing option to a seller.
If it's often with seller financing, the number one thing is there's not yet a trust established. If that lady knew that you would make the payments for the next how many years, she'd probably do it. There might be other circumstances, but I assume she doesn't have a mortgage on it, first of all, but so she can play the bank, or at least a part of it. But one thing that really helped me, and I stole this, I'm going to give away my age, I stole this from a Carlton Sheets cassette tape. But I didn't have any credibility with that seller. I met a guy, he had a for sale by owner sign in downtown Lancaster in New Street, a corner of New Street and Cherry Street, right next to the hospital. For sale by owner sign. Long story short, ended up buying a bunch of properties from him. He played the bank, and at first he was going to go another direction, but I had on this cassette tape, it said, if you don't have a trust with that seller, at least yet, and you have another property over here, or your personal residence maybe, or something you've been paying on for the last 5, 10 years, go get that report, print it out, and how frequently that your payments were on time. Give it to her. It's a way to build trust. I did that, and I'll guarantee you that made a difference, because he had no reason to trust me whatsoever. But the bank records on my personal residence, just being paid on time, gave him confidence that, okay, we'll be all right. And he knew I was going to improve the property as well. So if I didn't make the payments, if I was foolish enough not to do that, he was going to inherit a property back, but it was far more valuable than what I paid. So it was a win-win situation.
Did any of the rest of you want to add to that?
I think Darell answered it. It's really about knowing what they want. So that's what it comes down to in building the trust. But knowing what she wants, that's your number one thing. If she doesn't want, if she wants the cash, seller financing isn't going to work no matter how solid you look on paper, what you convince her that you'd pay her. If she needs the cash to move into a home, buy her to buy something else, she's not going to do it. So you got to find out what she needs.
Cool. One more question. Go ahead.
So bigger is always better. Debt to asset ratios don't matter and cash reserves don't matter. Is that correct? Just a matter of thinking.
Nothing like a loaded question.
Where did you hear this?
Trying to think how to paraphrase that. So the question is, bigger always better? Are we too worried about our cash flow and our cash position? Is that a good debt to asset? Okay, debt to value. Yep, debt to equity.
How many bills have you been able to pay with equity? Cash flow. That's what pays bills.
I always said it's really easy to go bankrupt in real estate. Running out of cash is like having a financial heart attack. And just when you need it, it's not going to be available. So despite, everything's got to be happy medium. If you watch your pennies and collect the rents and all that kind of stuff, rent to good tenants, it's probably going to work out for you. There's always a crash that could happen, but it's doing the basic things right. It's most likely going to work out for you. But ignoring financial metrics that are of long-standing history and value, you're probably maybe going to run into a problem. Like Benuel was talking about the 1% rule, that means that if you buy a property for $100,000, you should be getting rent of $1,000, and if you aren't, expect to put some money out of your own pocket so that your tenant can live in a nice place. That's not the end goal right out of the gate. The rents will probably go up eventually, but just know and expect and have the cash available to make up the difference from the negative cash flow.
Are you pulling any of that from my comment that I wish I would have gone bigger sooner? Maybe. I think bigger is always better if a whole list of things are true. If you have the right team in place, if you have the right deal, if your debt to asset ratio is reasonable. There's a whole list of things that have to be true for bigger to be better. And the reason to go bigger is simply if you want to accomplish some really amazing things, some really big things. Most people are going to be perfectly fine with, that could accumulate 5 townhomes, just put 30-year mortgages on them, pay them down over a long period of time. That's more than most people are going to have in their lifetimes, and that is perfectly fine. It's just if you want to go far beyond that, then sometime you have to break through a bunch of ceilings, but doesn't mean you have to do them foolishly, right? There's ways to mitigate just about any kind of risk you'd think of, and that is usually best not accomplished by over-leveraging. So there's that.
All right. Anything you want to add, Ron?
Yeah, I was just going to say, just go get started. Get started young and early, and make sure that when you're watching things, just adjust quickly when things change. Whether even something simple as the tenant's moving out, you can't let the property sit for 2 months because you're too busy to go fix something up to get it re-rented. It's got to be rented out right away again. Just everything like you got to move quick, but just get started. I think everybody up here would say, I wish I'd started sooner and bought more earlier and held more.
Good stuff. All right. How about a round of applause for our panelists? You guys can head back when you're ready. Thanks, guys. Be sure to say hi to them and shake their hand before you leave. They have plenty of other things they could have been doing besides being here, so appreciate you all coming out. There's something you wanted to say, Darell? Oh, okay. Yeah, you can head back to your seat. Yep.
Thank you, Chris.
Yeah, thank you. Thanks, Ron. Cool. A couple things to wrap up here. So next meeting, a gentleman by the name of Ryan Good will be presenting. He owns a trucking company, RGM Transport. They own about 40 trucks. He just sent me a message here with a quick summary. They own 40 trucks, and they manage an additional 50, so dispatching. So they have a lot going on. He's going to share his journey, why he started the business. He did dabble in real estate a little bit as well. It's definitely not his primary thing, but I'm looking forward to that. There's a sign-up sheet in the back. If you want to receive our emails or call blasts, put your information on the sign-up sheet. There's a QR code you can scan as well to follow our Facebook page or subscribe to our email list. We have a YouTube channel. You can watch past meetings if you liked what you heard here. There's plenty of years of meetings on the YouTube channel that you can watch. Yeah, that's pretty much it. Thank you all for coming out, and make a new friend tonight.